thousands of games, hundreds of studios, dozens of hub market partners, an industry-leading hub wallet, and just one API. Hub 88 is connecting businesses to a world of limitless content where the possibilities are endless. Hub 88.
All right, we're in. Hello and welcome to Next in Depth, a brand new podcast series where I'm going to be enlisting the help of expert guests like my fabulous guest today to cut through the noise and get straight to the heart of the most important topics in and around the gambling sector. Now, today we have a very special episode planned for you. It's something a little seasonal because with the Q1 earnings season now very much upon us, for the next few weeks, we are going to be bombarded, let's face it, with headlines about all the publicly listed companies in our sector and how they've performed during the first quarter of this year. So today, I want to do something a little bit different, a little bit special, and take a step back before we get hit with this barrage of information and just try and take a kind of broader view about how we should actually approach this. So the title of today's episode and the question we really want to talk about is how to analyze a financial report. And to help me answer that question, I am very pleased to be joined by absolutely one of the sharpest minds in this space. It is, of course, Regulus Partners' very own Mr. Paul Leyland. Paul, thank you for being with me. How are you today?
Thank you very much for having me. I'm great. Thank you very much.
Good. It's great to have you with me. You're going to be very helpful today. You are the expert guest. So I'm going to be firing lots and lots of questions your way to get inside your mind a little bit and work out how you do what you do so well. Because the reason I've invited you here, of course, at Regulus Partners, you follow lots of the publicly listed companies in the gambling sector. But for my money, Paul, you are very often giving the sharpest analysis out there. I think you have a real knack for kind of cutting through the noise and really getting to the core issues that are going on within some of these companies. And it seems to me that getting to that analysis is probably a little bit of a science and a little bit of an art all at the same time. And so really today, what I want to find out is what's your approach to providing that analysis? And of course, we'll see if we can share a few pearls of wisdom with our listeners. So today we've got a great plan. We're going to talk a little bit about your approach to analysing reports in general. And then we're going to have a look at Evolution's Q1 update as a specific example, because we've just got hold of that report. And I would be very interested to know exactly what you were looking out for when that first dropped. But for me, before we get into all that, I think there's one very important question that we could start with, if we can go right back to basics here and just set the scene a little bit. And that question is, in general, Paul, obviously these companies have listing requirements and they have legal obligations to publish these reports, and that's why they do it. But besides that, what would you say they're actually trying to achieve here? In other words, what are they trying to get across to their shareholders and to the broader market when they put these reports out?
So it's a lot of different things at once, as you'd expect, because there is an understanding that there are quite a few audiences, and a lot of it depends upon the nature of the company and the nature of the management. But first and foremost, these reports are for shareholders and bondholders in the capital structure, and those people who advise shareholders and bondholders, analysts sitting inside capital markets, in investment banks and brokers, etc. But on top of that, there is an understanding that the press will be looking at, especially for the larger companies or bigger bits of news. And so it needs to be accessible, it needs to be pithy. Shareholders have a very sort of broad range of interests as well. So the report has got to read well and sensibly for a shareholder who might own 15% of your company and has owned you for 10 years, and they know you inside out and they have a direct line to the chief executive. But equally, they've got to speak to someone who might be thinking about buying a few shares because they hear it's a great name. They've also got to be reassuring any concerns while talking up any hopes. and as you say, fulfilling all of the obligations and explaining things in a way that passes audit and sometimes also passes the time test. We can come on to that specifically with evolution, but it's very easy to make promises and statements in a given quarter and then hope perhaps that investors don't remember to read what you said a few quarters ago. But it's an art as well as a science, as you say, to write these things as well as to analyze them, because you've got to get that optimism across, but you've also got to get the realism across. You've got to explain things in a bland and proper way, but also you've got to make your company sound interesting. So it's an art.
Yeah, it's definitely a balancing act for sure, and it's interesting what you say about how many different audiences they actually need to address with these things. They don't have one singular audience in mind. I wonder if there's a tendency then to kind of achieve some of those objectives. Do you think there's a tendency to emphasize a certain type of information while maybe pushing another kind of lower down the list of priorities, let's say? I don't want to say they obfuscate or hide things from us. That would be very cynical of me. And I'm a very optimistic person. So what do you think? Is there a tendency to emphasize one kind of information over another?
Well, I think the answer to that can only be yes, if you're choosing between yes and no. But I think that there are a few different layers. So, for example, if a business is paying big dividends or is heavily in debt, the emphasis is much more on we're not making a mess of this and our cash flow is okay. Undue optimism is not that welcome. If, on the other hand, you're sitting on 40 times earnings and people are expecting you to grow at 30 to 50% a year, if you don't sound extremely bullish about your future, you're going to get a big hit. So you've got to get that balancing act right. Inevitably, people want to emphasize the things that are positive and de-emphasize the things that aren't so positive. But often that's what gets companies into trouble. Not just in terms of having to sort of talk guidance up or down, but in the end, what decides this is that a long-term relationship with investors. So actually being frank and being honest about a problem as it emerges is an awful lot safer than trying to brush it under the carpet, because if it then comes out that you must have known about this for a few months or a few years and you kind of obfuscated, then that can really lead to distrust. And it's very, very difficult to shake off distrust. The valuations are, people want to ascribe a capital value to something that they don't actually own themselves. They own a tiny fragment of it. So trust is at the heart of the system.
So when you come to look at reports, and obviously you'll have a very different relationship with each company you're approaching, perhaps some you may feel are more trustworthy than others, but when it comes to kind of maybe finding those areas where a company is leaving things out that may be pertinent, let's say, how do you approach this idea of kind of reading between the lines of a report? Do you have a formal approach to your analysis, or is it just a case-by-case basis?
Sure. To an extent, you can formalize it, and there are certainly particular areas to have a look. So one of the things that a lot of companies like to do, particularly if they've got their own software, is to capitalize the development costs of that software. And that is accountant speak for paying your staff in the cash flow statement, but not immediately through the P&L. And it appears in the P&L as depreciation and amortization. And so the way in which you can then talk up something really positive is keep talking about EBITDA. And EBITDA, you can have a look on the internet for this. It's most cynics see EBITDA as a made-up figure, and I'm broadly speaking, I'm in agreement. EBITDA can be made up. It's not always made up, but it can be practically made up. If you're not looking at free cash flow, you're potentially missing quite a lot. Equally, I think the principal role of financial statements is to have a strategy piece and a finance piece, and the bit that can be easily left out is operations management. actually what the company does. And so trying to understand what the company does is what, even when I was an equity analyst, it's the thing that I tried really hard to make sure I had a real grip on that. Because then when you read the strategy and you look at the numbers, you think, does this really add up? Or is this being made to look like it's adding up, but the company's not really capable of delivering what it says it wants to deliver, or it's not really doing how you could read the optimistic way of what it's doing. So in gambling, you can see that, for example, by we're not breaking any laws. Sure, of course you're not breaking any laws, but that doesn't mean to say that there aren't potential enforcement issues in what it is that you're doing. Or even worse, you might not believe you're breaking any laws, but then you find that actually when someone comes knocking, you are. So I think that inevitably people will always put the most positive spin on things until they're explaining a profit warning. That's why profit warnings exist.
Mm-hmm. It's an awful lot to consider, and I think for the layperson, it's more information than most people would kind of be thinking about if they were just reading what was given to them on a report. They always seem to have this positive spin. It always sounds like a good investment. Do you think this is why so many people recommend, for example, to retail investors, just buy an index fund and hold it and don't bother trying to pick particular stocks?
Yeah, I think that's right. I think as well, hedge funds, pension funds, etc., spend an awful lot of money, both themselves and with banks and brokers, really understanding things and having huge models and crunching lots of numbers. And then they can move really, really quickly the minute the market opens. In fact, not always when the market's open. So for a retail investor to slot into that with their tips and their view, even if they have a really cool spreadsheet, it's challenging. So the problem as well, one of the great things I enjoy about doing my strategy analysis at Regulus rather than equity analysis as an investment bank, is that it's much more about the company rather than the share price. And the thing with a share price is, and to speak to your optimism point, even in a bear market, stocks go up most days. It's normal for stocks to go up a bit regularly and then come down suddenly by a lot. A bit like evolution today.
Yes.
So
welcome to that.
So I think it's important to bear that in mind. It's you might have a very clear view on the company and you might think the share price is right or wrong, but here's the catch. If you think the share price is wrong, there's nothing to stop it being wrong in a year's time. And if the share price is right, then it's quite difficult to see value. So that's also an issue in terms of understanding valuation and understanding timing. And doing something else with your time is probably a good idea.
Yeah, no, it makes a lot of sense. Now, you obviously are very focused on the gambling sector, and I think maybe people could imagine it all gets a bit same between these public companies, but in fact there must be quite a lot of variety. And when it comes to each reporting season and you're analysing the strategy and the results of each of these different companies, how much variety is there in terms of how you approach one company compared to another? Obviously it's going to be different, one that's very sports betting focused versus online casino, but there must be much more to it than that.
There absolutely is. So there's, in all sectors, so this is not a gambling specific point, in all sectors, the quality of management ranges considerably. And the average tenure of a CEO is, off the top of my head, roughly 5 years. So if you think about looking at 20 companies, you've actually got quite a lot of management turnaround to understand, who's in, who's out, who's good, who's struggling. On top of that, you've got enormous differences in regulatory risk profile, in channel risk profile, and that's not just the same as land-based is struggling and online is growing. I mean, that was probably true 10 years ago, but it's not so much the case anymore. It's sometimes easier to run a land-based company indifferently, and you're still there in 5 years' time. Everyone's bored, but you can pay a dividend and satisfy your investors. You run an online gambling business badly, and you're done and dusted in a few years. You're out of there. So just because you've got secular growth, as in overall market growth, and that's one of the things that we try to get across all the time. Overall market growth does not mean a company is going to grow. A company has got to access that growth by making sure they're positioned well from a product, a channel, a regulatory risk point of view, and not mess up.
That's the key thing. Don't mess it up, I guess. Yeah. Speaking of the management changes, just quickly, we've had Stella David announced as the permanent CEO at Entain now. What did you make of that? I think yesterday you put out a statement about there's quite a lot of reassurance in that appointment for
yes,
shareholders.
And that was a cheeky reference to Stella Artois, but. Yes. So yeah, it is reassuring though. You couldn't argue that Entain was reassuringly expensive at the moment, but that's its own positive thing. It's been through the mill. It needs some stability and security. Bringing in somebody completely new is the opposite of that. Stella David has been on the board since 2021, so she's seen it all unfold. She's been a witness and an actor in terms of being an interim chief exec twice. So it's about the steadiest hands that you can get, and that is a group entity that requires really steady hands, because that's another thing to bear in mind. We talk informally about a company. I would not know how to count how many companies are part of Entain Group. And while some of those companies might just be legal entities, an awful lot of them are living, breathing, organic businesses that need to run on their own. Yeah. So it's, I mean, Entain CEE is a thing, but running Croatia is different to running Poland, which is a different thing again to running Brazil, which is a different thing again to UK. It's really complicated. Yeah. So having somebody sensible at the top is welcome.
Yeah, good. Well, we'll see what the impact of that is, of course. I think, during her 2 interim stints as CEO, we saw some pretty positive movement at Entain. So anyway, we've got a bit of positive news for Entain, but we're going to talk a bit more about Evolution today. So we've just had their Q1 report. Shares are currently trading down about 16%. So the market obviously was not particularly pleased with what it saw. I don't know if you knew what was coming, Paul, but before that report came out, what was going through your mind in terms of what you were going to be looking for?
So I think with Evolution, there's 3 and there were 4 things that we were thinking about. The first is, to what extent are they maintaining growth momentum in live, which is their core, or is it showing signs of maturity? And we're increasingly seeing signs of maturity spreading more broadly than just certain key areas. Second, are they turning around RNG? And, this is one of those things that every single quarter, next quarter, it's going to be great. We've got this great library. We've got these amazing games that we're going to launch. And lo and behold, it's the same. And that speaks to, I think, a company which has an extraordinarily strong grip on its core skill set. And RNG is not its core skill set. Infrastructure is different to content. In a very broad terms way. The third is the regulatory piece, and that captures all sorts of issues in terms of where is Evolution making its money, and to what extent are there changes taking place which are going to put pressure on that, and that could be material regulatory change in Brazil, as we've seen, or in Netherlands. In different ways. It could mean that the results of their own regulatory scrutiny and mitigation, again, as we've seen. And then the additional issue with evolution was obviously the sort of the capacity related things with Georgia and the strikes and the extent to which the company was managing that. And that does appear, insofar as they've said it is, and it looks that way, it does appear to have sorted itself out. But these things have only sorted themselves out when both sides have decided that they're sorted out, and so we'll see. So there aren't that many moving parts to evolution, notwithstanding the fact that it's a very, very big company. What it does is relatively clear and relatively siloed. So it's not like looking at one of those group entities that has got so many different businesses in so many different parts of the world, all of which do different things, all of which need managing differently. It's got two divisions, and those two divisions are logically structured as distinct divisions. So there isn't a huge amount to worry about. And I think that, it also doesn't take a rocket scientist to read that report and think, oh, because you read 4% growth and you think that's not what we buy evolution for.
Yeah.
Don't need to go further than that. Now, you then do to think, okay, if I want to buy a dip, where's the dip? A great old stockbroking sort of anecdote is a stock which is down 90% is one that fell 80% and then halved. So, just because it's gone down doesn't mean it's not got further to fall. So that's not a prediction on what evolution share price is going to do. Only that understanding what a dip is quite tricky. Another one of those sort of old wives' points about is don't catch a falling knife. So that way the minute that evolution puts out we've only achieved 4% year-on-year growth, the shares are coming down. That's when you then have to go through all the statements and understand, is this a one-off? Is this a hiccup and they're going to, trade through it? And then that means there's really easy comps. And so this is a great opportunity to buy, or are there more structural things going on? And then it also goes back to that honesty point. To what extent is management sort of saying, look, there are things that we need to change, or are they saying, it's all fine, really? So there's a lot you then have to take a judgment on after that inevitable initial shock, which is captured in one number, and the rest of the report, so what?
Yeah. So what was your take on what might have been missing from that report, if anything? Did you feel, I'd say they've been pretty upfront with us and pretty frank about the fact that they're not happy with the growth that they've seen. Did you think that their explanations and their continued, let's say, relative optimism towards the rest of the year, they say this is going to continue to have an impact in Q2, by Q3 and 4, the EBITDA margin is going to go back up? I know we've already talked about EBITDA and what that really means. What was your take? I mean, do you buy it, basically?
I think that the one of the things with evolution is that because it's such a clear market leader in what it does, and because it does what it does pretty much all over the world, it's much harder to benchmark than a lot of other companies. So if evolution were competing, and this is one of the reasons why we think RNG is struggling, because the competitive landscape is completely different.
Yeah.
If evolution had 5 or 6 competitors which were really strong, then when you sort of lose momentum, it can be really hard to pick it up again, because there's other people to take up the slack, and then you've got to fight for market share, even in a B2B sense. But evolution is in a slightly different place than that. So one of the problems with evolution is that we kind of just don't know. It's very difficult to form a view on that. And a lot of it, I think, is, the Gambling Commission announced an investigation on, I think it was the 20th of December, or just before Christmas, saying that we're concerned that there's some black market activity going on. I think if there is a criticism, it is probably that someone who didn't know the sector really well, and even me, I think I know the sector reasonably well, penetrating the euphemisms can be quite difficult. what actually have you been doing and what have you done that's different? And to what extent is that now clear? And to what extent might that contain risk? I defy anybody to read to get that answer from what was written down. But at the same time, if they did try to write it down, their lawyers would be pressing delete. So, it's very difficult to say.
Yeah, I think the UK question seems to be having an impact across the rest of Evolution's operations as well. And one of the things you wrote in your analysis of this report was this increasingly clear division between black and white markets and the shrinking of this grey area in the middle. If I remember rightly, the figure of locally regulated revenue was up to something like 45% in this report. How far up towards 100% do you expect that to keep going because of this, this increasing scrutiny and regulatory change?
Well, I think there's lots of areas of the world that are just not yet regulated. And so, evolution sort of alludes to this as well, that there are two elements to this. The first is, are you generating money that's not regulated but not a problem? Are you generating money that's not regulated and could become a problem? Mm-hmm. Or are you generating money that's not regulated and really is a problem right now, like black markets, which is, and understanding that if you're generating money from regulated unregulated markets or markets that have not domestically regulated, because they're all regulated somewhere, mm-hmm. And that there is a potential long-term pathway to regulation, but even if there isn't, there's no enforcement. There isn't a particular problem with what is going on, or whether that's fewer and fewer markets now. Then having that not domestically regulated bucket isn't a big deal, and why not make the money? And it tends to be quite high margin. If you're making money in markets where you're not at any material risk right now from how you're operating, but those markets might change adversely, and then you lose out, that is something to analyse. And that is a question of, the direction of travel of revenue and costs. But if you're doing something right now that you really shouldn't be doing and you've kind of been caught, then that can be a much bigger, more serious issue, depending upon what happens next and how serious it is and how serious regulators take it and what other regulators think about what you've done. And like I say, it's quite difficult to penetrate which of those layers is going on here, given the sort of euphemisms. And I don't want to, but there has been a reduction in revenue in Europe down to something called ring fencing. Mm-hmm. And at the same time, stop, next sentence, a bunch of these markets in Europe have low channeling rates, and that's not our fault. How do you join those dots?
Yes. Well, we'll see. I guess that key percentage, again, it leaves out so much of the subtlety and the context. It's just it's 45% this quarter. Okay. It doesn't really tell us that much, but I do think it's a kind of key metric to watch, and we'll see what the direction of travel is basically in the coming quarters. I wonder if this is a related issue in some way, because another, I think, potential challenge facing Evolution, as you pointed out after their full year report last year, was that they do have a significant reliance on a small handful of large customers. Is that something that you see presenting potential problems further down the line as well? If they were liable to, lose one of those customers, of course it could be catastrophic, but what's your take on that kind of top heavy client base, let's say?
It's not all that top heavy on a simple sort of Pareto view. The sort of 80-20 rule applies to nearly all products that you're not forced to consume, essentially. So that customer reliance as a percentage isn't that dramatic. The customer reliance in absolute numbers, though, is more interesting because, you can see Flutter and Tane. I mean, Bet365 is less relevant in this because it's so sports betting weighted, but, with a little bit of a lag, you can see their accounts. And from historically what they've said in their accounts, you can work out what their gaming mix is reasonably accurately. And so you can start thinking, all right, we know what Live Dealer is as a mix, and we know what RNG share is as a mix. We can therefore have a vague idea from industry knowledge and common sense, what is the B2B rate being charged on that. And then we think, okay, so this is the total footprint of some of the largest companies that we know to exist that are visible in regulated markets. All right. Is that customer number one or customer number two or customer number three? And that's where it becomes quite interesting. It's not the weighting to customers, but the scale of these customers and what that might imply.
Yeah, no, it makes a lot of sense. Now, before we kind of move on to our final section of the conversation, which is going to be about how to apply all of this analysis, I do want to take another quick look at this question of RNG and get your opinion on that, because you have so much experience looking into other companies that are in that sector. I kind of want to work out what Evolution's doing wrong here. Shareholders have been saying for years and years and years since all these acquisitions went through of the other studios, please bring RNG growth in line with live growth. I don't think bringing live growth down to 4% is what they really meant by that. So Evolution sort of got the message, sort of didn't really. What's the problem? I know is it a skill issue? It's expertise, it's focus, it's a bit of everything, or?
I think there's a few things going on. So historically, there have been, I think, 4 ways in which RNG has worked really, really well. The first way is that essentially, as a B2B provider, you're controlling your value chain. So you've got such deep relationships with potentially ownership of your core customers that you have that pricing and volume control, a bit like in the old days when breweries used to own pubs, and most people listening to this channel will be able to think about some vertically integrated businesses either obviously or by the back door. So that's one way in which it works. And Evolution doesn't really have that. I mean, NetEnt arguably did way back in the day, but not so much not at all anymore, but really way back in the day when they first started. Second is that you are you get really lucky with a really, really good game or a really good sort of design feature, and off you go. And the problem then is that it's very difficult to replicate because there's a lot more art than science in it. And so the big problem is if you buy a company that's done that and you pay as if that company is going to do it again and it doesn't, that's a bit tricky. Whereas if you organically develop lots and lots of studios at much lower cost, you don't capitalize it, you can have a go at a small number of developers coming up with something really cool, maybe, and if not, just churning it out and it doesn't matter. But when you've paid for hope and you don't deliver hope, that's more challenging. Third, you can be a really, really good sort of local specialist. Because customers in each country have different tastes because regulations force different things. But again, that's difficult for Evolution to do at scale because it's a global provider of live. So even, absolutely smashing and owning the German market, and that's us, that's what we do, doesn't add up to group-wide growth. And so the fourth way in which you can gain scale is through M&A, which is largely what they've done. But the problem with that then is that how do you scientifically produce good games over and over and over again without living and breathing it and understanding it, when you've got loads of competitors also trying to do that as well, and they really live and breathe it and understand it because they're not infrastructure companies. They're R&G specialists, they're content development specialists. I mean, obviously, Evolution has a huge content element to it, but overwhelmingly its USP and the thing that locks it in place is its capacity to deliver infrastructure.
Yeah. Can you think of any competitors who are kind of, just off the top of your head, who are kind of outstripping Evolution in this sense? Who's leading the charge in terms of actually getting hold of that growth in RNG? Because it does seem to be a slippery one to be able to hold on to, basically.
Well, absolutely, and I think it's significant given that we're talking about how to do financial reports. It's not listed companies. It's not companies that we can see, and I think that's quite significant. And I think that there are fashion cycles here, which is why I'm sort of deliberately not naming names, because there is always. I mean, there are certain companies, one of which sponsors a lot of what you do, which are clearly doing very well in terms of growth and scale. But this is a much more fluid and much more murky environment, and I think it's dangerous to look at it on a global view, because when you're buying content, you tend to be looking at what content is going to work in the market or customer segments that I'm looking at. And that's what you really want. So the fact that you're really big is less relevant to, are you really good at what you do in the area that people want to buy? And then you can, that's why people have thousands of games from tens and hundreds of suppliers. That's not what you want with your live dealer, though. So it's not a question so much of who's doing well and who's not doing well. It's a question of the structural differences between an ecosystem that not just supports but thrives on loads of competitive development studios, even internally, even in a group of environment, you want lots of small studios.
Yeah.
But that's not the case. Having lots of small live studios will just wipe out those margins and benefit nobody. So it's structurally different, and that's kind of the point about the operations management piece as well. It's very easy to say we're a really big global gambling company in B2B. We're really good at doing content and software development. Look at us. So we're just going to do that in this adjacent sector. And we've been very, very skeptical from the minute they bought NetEnt and expected sideways.
Yeah. Now, do you envision any future in which Evolution decides to offload some of these companies and get out of the game a little bit and put its focus where its expertise are? Or do you think giving up that additional scale, even if they're not growing very quickly, Evolution wants to cling on to that scale?
I think I can't imagine this management and this share price with this level of regulatory pressure doing that, because I think they're still wedded to the strategy. And also you kind of do need more strings to your bow. I think that the problem has been over-promising growth and probably overpaying for assets, rather than the strategy of having an RNG division that throws off cash and can potentially weld itself to something more dynamic and more interesting over time. I think absolutely stacks up. The problem is assuming synergies that I don't think existed, and also promising turnarounds that haven't happened. So it goes back to your very first point about what a financial report's for, and that's where you get that trap between the optimism versus the reality, which is, to be fair, that's not Evolution, I think, obfuscating at all. It's Evolution believing they could do something that they so far have not been able to do. But that doesn't mean that it's wrong, only that it's disappointing.
Yeah. Well, taking into consideration that disappointment, let's say, looking at the numbers, and this may be an incredibly irritatingly oversimplified question for you, Paul, but once you've got hold of all this information, if you want to set a target price or make recommendations or whatever, how do you actually use all of this to then assess a company's value?
Yeah, sure. So one thing to be clear on. So we don't do that because we don't provide financial advice. We don't provide equity advice. But I thought it was worth talking about that because that's what I used to do in a previous life. And a lot of it depends upon what you want to achieve. So, for example, back in the day when party gaming was a big thing rather than a small pimple with an Entane, I was always had a sell recommendation on party gaming, and unless and until the share price cratered, and that was during the US phase before UEGA, and then afterwards as well. And people, particularly the salesmen that I used to work with, were like, "What? Why have you got a sell recommendation on this stock that keeps going up?" And my response to that was very simple. I want to say in one word, don't trust this stock, which is not the same as I think the share price is going to go down, albeit, it goes back to that point that shares go up by increments on hope and then come down hard very quickly on reality. Mm-hmm. So a lot of it is about signaling, if you've got a recommendation on something, your audience is people who are buying and selling those shares, typically institutional investors. And so what you're trying to signal there is, talk to me about this company, this stock, because I've got something interesting and valuable to say, more than it is about saying, oh, I think this is going to go up, or I think this is going to go down, because that's the city occurs, or Wall Street occurs, mostly behind closed doors. What people write is often very much a marketing piece. So it's not just the case that companies are writing stuff that you try to have to read between the lines on. Analysts are doing it too.
Yeah, absolutely. And in terms of the actual, some of the nitty gritty and the maths and the real like equity analysis in your former life, what were the key figures that you would be looking at? I mean, we've discussed EBITDA and how that can be kind of massaged one way or the other, but you have, some people would say that the only thing that matters is earnings per share, or they might want to talk about enterprise value or book value or free cash flow or whatever figures they decide are the most important. What was your take on that as an equity analyst?
So I think there is definitely no one figure, but I think it's absolutely right that some figures are more misleading than others. Anything in the P&L below revenue, depending upon some revenue recognition, especially in B2B, can be very cute indeed. So on the B2B side, very often you can't even trust the revenue figure. So the cash flow statement is any good analyst's best friend. Everything else can be massaged one way or another. Even the cash flow statement can be, but you can start to smell the bullshit there the most. And there isn't any particular figure at any particular point. It is more a case of looking at everything over time and seeing how it develops. And even if a company is losing money, that's not necessarily a bad thing, so long as there is a pathway to generating cash. And I think that's one of the things that a lot of people, obviously they know, and if you say it, people say, well, obviously that's clear, but what is the pathway to a company making enough cash for its valuation to stop being expensive? Is, to my mind, the biggest single question. The second biggest single question is this company doing anything that you're going to read about and have to justify why you were holding the stock?
Now, if I can just wrap this up by trying to apply those two questions to Evolution and what we've learned from their latest report, there's been a lot of talk in recent years about this exposure to unregulated markets and how that means, in some people's eyes, that the stock has been overvalued. I'm not sure exactly what multiple it's trading at today, but I know that it's around the same price today as it was back in, I think, 2020. So there's been a pretty significant reality check among investors. Some people, I'm sure, will still argue that it's overvalued. I know you don't want to offer any advice on what the price should be or what it will be, because we simply don't know. But do you have a take on this? Do you think it could be overvalued, could be undervalued? Is it more or less attractive than other companies in the sector? What do you think?
So I think that I go back to the point that Evolution is far and away its market leader globally in a bunch of markets which are quite visible and a bunch of markets which are not visible. And, the latest regulatory correction occurred in Europe. And I suspect that everybody who was thinking they must be up to stuff didn't have Europe in mind. So I think that Evolution is one of those companies that is very, very difficult to get to know because you can't understand its peer group and apply where it fits in. So I think that's the complexity. This is a company, I think, that trades on momentum and trades on very good execution, but at the same time, really getting to understand what are the mechanics of this company and whether or not it's going to surprise on the upside or the downside is really, really challenging. And so if an investor isn't up for that challenge or would wake up one morning and discover that the stock's down 20%, and don't be surprised. That's the only thing. This is again, to use an old city expression, this is not a stock for widows and orphans.
There you go. Well, Paul, it's been absolutely fascinating to take a look behind the curtain of the analysts. It's sometimes a slightly mysterious world to us mere mortals. It's great to get your take on things. It's been an absolute pleasure. I think we've all learned a lot. There's loads and loads to consider here in terms of a general approach to analysis and also looking at Evolution specifically. So thank you so much for joining us. It's been an absolute pleasure to have you here. I hope you'll come back and join us another day.
I'd be delighted to. And if I'm allowed to say it, our content's free to subscribe to. So if you found that interesting, our Regulus financial updates are for anyone who's interested. And there is an unsubscribe button for when you stop being interested too.
No, quite right to point it out. I always look forward to your updates, Paul. I really do. You are always on the money, if you'll pardon the expression. Thank you very much for being here, and we will see everybody here again in just a couple of weeks. That's it for today's Next In Depth. So thank you once again, and we'll see you next time. Goodbye.
Thank you for having me. Thanks. Goodbye.
The captain has turned on the fasten seatbelt sound.